Assalamu alaikum, my name is Aisha. In this video, we will do analysis of case study named Replacement of Facilities at Hirshleifer Company given in the Book of Capital Budgeting written by Peterson and Fabozzi. Our understanding developed after analyzing the case study, it will cover following points. Number one is what is the problem statement given in the case study. Hirshleifer Company needs to decide whether to replace its existing manufacturing equipment with a new one. Analyze the cash flows resulting from this replacement decision. Determine the annual cash inflows and outflows for each of the 5 years, taking into account the purchase price of new equipment, depreciation expenses, production cost savings, inventory reduction benefits, and tax consequences. Number 2 is what are various investment decisions involved in the project. So the investment decisions involved in project are evaluating the cost of purchasing new equipment, which is $3 lakh, versus selling the old equipment today, which is $120 lakh. Assessing production cost saving, which is $60,000 annually, tax impacts from depreciation and equipment sale, and considering the inventory reduction of $10,000. The goal is to determine whether to continue with present equipment or replace it. Number 30 is explain both the new investment and asset disposition decisions. New investment decision. Cost of new equipment. The company will need to make an immediate cash outlay of $3 lakh to purchase the new equipment. Depreciation of new equipment. The new equipment will be depreciated using Macker 5-year schedule where 94% of equipment's cost is depreciated over 5 years. By the end of year 5, the remaining book value, that is also called tax basis, will be $17,280. Tax on sale of new equipment. At the end of useful life of equipment, the new equipment is expected to be sold for $1 lakh. Since the sales price exceeds the book value but less than original cost, so there is a gain of $82,720 taxable at ordinary tax rate. The tax on this gain will be 35% of $82,720, resulting in a tax outflow of $28,952. Operating savings. The new equipment will generate annual savings of $60,000 in production cost, and there will be an immediate cash inflow of $10,000 from reduced inventory requirements. So though this inflow will reverse at the end of the 5 years when the inventory returns to its original level. Asset disposition decision. Current sale of old equipment. The company can sell the old equipment today for $120,000. The equipment's current tax basis is $1 lakh, so selling it today would generate a $20,000 gain. This gain is called a recapture of depreciation, and it will be taxed at ordinary rate of 35%, resulting in tax outflow of $7,000. Tax on foregone future sale. If the company retains the old equipment, it is expected to be sold in 5 years for $10,000. The tax on this future sale would be 35% of $10,000, generating a tax inflow of $3,500. By selling the old equipment now, the company will forego this future cash inflow. Foregone future sale. Additionally, by replacing the old equipment now, the company forgoes the future sale of old equipment for $10,000 at the end of its life in 5 years, which must be considered as an opportunity cost. Number 4 is what are the effects of depreciation on taxes in case of new acquisition and asset disposition decision. Depreciation reduces taxable income, creating a depreciation tax shield. In the case of new acquisition, accelerated depreciation measures will increase the tax shield in early years, reducing tax payments. Upon asset disposition, there is gain from selling above the depreciated book value, which is also called tax basis, and it will be taxed as recaptured depreciation, resulting in a tax outflow at ordinary tax rate. Number 5 is, are there any tax credits on acquisition of any equipment? No, there are no tax credits available on acquisition of any equipment because it is not mentioned in the case study we have studied. Number 6 is this project a new acquisition project or a replacement project? This is a replacement project because the company is replacing its old equipment with the new equipment. Number 7 is how the equipment will be depreciated over the life of project. Explain in detail the various depreciation methods involved in a project. The old equipment will be depreciated using straight line method over a 10-year life. If the old equipment is kept, depreciation would continue for each of the next 5 years, and if it is replaced, there would no longer be this depreciation expense. The new equipment will be depreciated for tax purposes using MACRS and a 5-year classified life with specified rates which are 20%, 32%, 19.2%, 11.52%, and again 11.52% in the 5th year. Now we will go to Excel sheet to further understand the various depreciation methods involved in project. Cost of old equipment, as we saw previously, is $2 lakh and economic life of old equipment is 10. So the straight line depreciation is $20,000 for each of the 5 years for old equipment, which is calculated by dividing the cost of old equipment by economic life. And now we will calculate the depreciation of new equipment, which is calculated using MACRS. So cost of new equipment is $3 lakh, and then we apply these rates 20%, 20% in first year, 32% in second year, 19.2% in third year, 11.52% in fourth year, and 11.52% again in fifth year to calculate depreciation expense of new equipment. Now we sum the depreciation of all the 5 years, and our total depreciation for new equipment is 2,82,720, and total depreciation of 5 years for old equipment is $1 lakh. Now we will again go to our PPT. Next question is, what are the cost implications of old equipment? Will there be any gain on its sale? Whether the gain will be a capital gain or a recapture of depreciation. The old equipment was originally purchased for $2 lakh 5 years ago and has been depreciated on a straight line basis, leaving a current tax basis of $1 lakh. If the company sells this old equipment now for $120,000, it will generate a gain of $20,000, which is the difference between the selling price, which is $120,000, and the tax basis, which is $1 lakh. This 20,000 gain is considered a recapture of depreciation, which means that it will be taxed at the company's ordinary tax rate of 35% because the selling price is still below the original purchase cost of $2 lakh. Number 9 is there any sunk cost involved in a project? The 2 lakh cost of old equipment is a sunk cost which is irrelevant cost to our analysis. Number 10 is what are different cash flows involved related to taxes in case of disposition of old equipment. Disposing of old equipment has two tax related cash flows. Number 1 is selling the old equipment today results in a tax outflow of $7,000, which is 35% of $20,000 gain from the sale. Second, if the company keeps the old equipment and sell it in 5 years for $10,000, there would have been a tax inflow of $3,500, which is 35% of that future sale price. By selling now, the company foregoes its future tax inflow. Next is, if the firm replaces the old equipment today, what will it forego after 5 years? If the firm replaces the old equipment today, it foregoes the sale of equipment in 5 years for $10,000, and it also foregoes tax inflow of $3,500 on future sale of equipment. Number 12 is what yearly benefit the company will earn in case of reduction in expenses when the new machine will be installed. The new equipment is expected to reduce production cost by $60,000 each year. Since it is more efficient, company can reduce its raw material and work in process inventories. Company expects to reduce its inventory by $10,000 due to installation of new equipment. Next is why there is no effect on revenue due to change in equipment. There is no effect on revenue from change in equipment because the replacement does not directly impact the company's ability to generate sales. The new equipment mainly improves efficiency by reducing production cost and lowering inventory levels, but it does not influence the volume of sales or pricing, which are the primary drivers of revenue. So the equipment replacement affects operational cost but not revenue generation. Number 4 is explain the depreciation tax shield received by company due to this investment. Installing the new equipment will lead to higher depreciation expenses, which in turn lowers the company's taxable income. This reduction in taxable income creates a tax benefit known as the depreciation tax shield, allowing the company to save taxes. The tax shield offers considerable savings, particularly in the first few years, as depreciation is higher in early years due to accelerated methods like MACRs. Now we will go to Excel sheet to further understand the depreciation tax shield received by a company due to installation of new equipment. For this, we will first take the depreciation expense of new equipment, which is 60,000 in first year, 96,000 in second year, 57,600 in third year, 34,560 in fourth year, and 34,560 in fifth year. And depreciation expense of old and we will take depreciation expense of old equipment, and then we will calculate increase in depreciation, which is the difference between depreciation expense of new equipment and depreciation expense of old equipment. And by doing this, we will calculate increase in depreciation for each of the 5 years. And then depreciation tax shield is calculated by multiplying increase in depreciation by the tax rate, which is 35%. So the depreciation tax shield received by company in first year with the installation of new equipment is 14,000, and depreciation tax shield received in second year is 26,600. Depreciation tax shield received in third year is 13,160, and depreciation tax shield received in fourth and fifth years are 5,096. Next one is how managers practically make important investment decisions. Managers combine financial analysis with subjective judgment when making investment decisions. They estimate future cash flows based on factors like sales, expenses, taxing, and working capital needs, which are the key elements of operating activities. Competitors, tax changes, and market conditions are also considered in cash flow estimates. Standardized procedures guide the estimation process, but managerial experience that managers gain over time plays a crucial role in refining estimates. Tools such as sensitivity analysis and post-completion audits are used to assess risk and improve decision making. Investment decisions ultimately balance quantitative data with qualitative judgment of the managers. Next one is, what are your key learnings after reading this case study? The key learnings that I learned from this case study are: evaluate the change in cash flows when replacing existing equipments, that is the incremental cash flow. Financial techniques can be used to evaluate the project like NPV, IRR, ARR, PBP, etc. When estimating cash flows, companies look at important factors like sales, expenses, taxes, and working capital. However, simply using formulas to calculate these estimates isn't enough because there are many unpredictable factors involved. Managers can use financial models to bring all these elements together, but they also rely heavily on their own judgment and experience. In addition to numbers, decisions are influenced by insights from marketing research, technical evaluations, and the hands-on knowledge managers have gained over time. So while calculations are important, real-world experience plays a key role in making accurate cash flow estimates. In the end, we will see estimated incremental cash flows from replacement of facilities at Hirshleifer company. For this purpose, we will first calculate investment cash flows. Purchase and sale of new equipment. Purchase of new equipment in the initial year is of -3 lakh, and sale of new equipment in the year 5 is of +1 lakh. Tax on sale of new equipment, which will outflow in the year 5, is -28,952. This tax is calculated by multiplying the gain with the ordinary tax rate, which is 35%. This gain is calculated by subtracting the tax basis from the estimated sale price. So the tax on sale of new equipment in the year 5 is 28,952. Sale of old equipment when it is replaced with new equipment in the initial year is 120,000. Tax on sale of old equipment is 7,000 which will outflow in the initial year. This tax is calculated in the same way as we calculate the tax of new equipment. Foregone sale of old equipment after 10 years is 10,000 as it is mentioned in case study. Since we lost this opportunity, so we will outflow this 10,000 in the year 5. Foregone tax on future sale of old equipment is 3,500 which will inflow in year 5 because we have not paid this tax. This tax of 3,500 is calculated by multiplying the foregone sale of old equipment with which is 10,000 with the ordinary tax rate which is 35%. Change in working capital in the initial year is 10,000 which will inflow because the new equipment will reduce the working capital, but this as the inventory returns to its initial level at the end of the project in the year 5, so that working capital will again outflow of minus 10,000. So the net investment cash flows in the initial year is minus 177,000 and net investment cash flows in the year 5 is 54,548. Now we calculate change in operating cash flows. For this we will first take change in revenues which is 0 in the 5 years as it is mentioned in the case study. We will subtract the change in expenses from change in revenues. Change in expenses in each of the 5 years is 60,000 because the new equipment will reduce the production cost by 60,000 each year. Now we will subtract the change in depreciation which we calculate previously, and that is calculated by that is the difference between the depreciation expense of old equipment and depreciation expense of new equipment. Now the change in taxable income is calculated by summing up all the above values. Now we will subtract change in taxes from change in taxable income. Change in taxes is calculated by multiplying the tax rate which is 35% with change in revenues minus change in expenses minus change in depreciation. Then we will calculate change in income after tax by subtracting change in taxes from change in taxable income. So change in income after tax is 13,000 in the year 1 minus 10,400 in the year 2, 14,560 in the year 3, 29,536 in the year 4 and 29,536 again in the year 5. Now we will again add depreciation because depreciation is just a book adjustment, so we again add it. So when we add the depreciation, the change in operating cash flows is 53,000 which is calculated by summing change in income after tax and depreciation. So the net cash flows at the end in the initial year is minus 177,000 and net cash flows in the first year is 53,000. Net cash flows in the year 2 is 65,600. Net cash flows in the year 3 is 52,160. Net cash flows in the year 4 is 44,096 and net cash flows in the year 5 is 98,644. So this is all for the video. I hope you will understand it. Thanks for watching. Allah Hafiz.